Hey everybody, so in this video, I wanted to talk about selling deep in the money calls and just the thought process that has to go in when you do this. So if you're familiar with selling a call, then you know what, that's pretty good. And this will be very easy for you to understand. But if you're not familiar with selling a call, I'll just explain it very briefly. So when you sell a call, you essentially have to have 100 shares of the underlying asset. So let's just pretend that I'm buying 100 shares of QQQ right now at about $262. Now, when I'm selling a call, I'm essentially shorting against my own shares. So this is a form of protection. Now, let me just show you the options chain. And we're going to go through an example, and this is going to be much, much more clear. So let's just pretend that I want to sell an option that goes all the way out until June 30th of 2023. Now that time frame is essentially 8 months. So that is November, December, January, February, March, April, May, and the end of June. So that is 8 months right there. Now, if I were to sell a in the money call, that essentially means anything below the current share price. If I were to sell a deep in the money call, that means something far below the current share price. So right here, these are all our strikes, and I'm going to explain what this means. So let's say that we want to sell the 200 strike call dated June 30th, 2023. So this is what it means. It means if by June 30th of 2023, if the share price is above $200, I need to basically sell all 100 of my shares for $200 plus the premium that I received for selling this call. So when we sell calls, there's a bid and an ask. The bid is the price that the market is willing to pay right now for this contract. So if I sold this 200 strike call, somebody will buy it for 72.05. Now 72.05 is representing one share. Now if I multiply this by 100 shares, that's going to be $7,205. So you would be getting $7,205 immediately when you sell this 200 strike call dated June 30th, 2023. Now, like I said, if QQQ is above $200 by June 30th of 2023, you have to sell for $200 plus the premium. So what is that? Let's calculate that. So that's $200 plus 72.05. So we would essentially be selling all 100 of our shares at 72.05. What did we basically buy it for? Well, we bought it for $262. So we're going to subtract that by 262. All right, so our profit is $10.05 a share. Let's go ahead, let's multiply that by 100. So we made $1,005 in 8-month time span. So you know what? That's not really a bad deal. Now, what are we going to get if we invest the same amount in a bank account? And let's just pretend that our bank account savings rate is about 3%. So let's go ahead, let's see what that is. So here, I have a little calculator. Now I invested $26,200 because we bought at 262. So that's $26,200, 3% interest, 8 months, and it's compounding monthly. So let's calculate that. It's 26,728 is what we will receive at the ending balance. Now I'm going to show you how they essentially calculate this through Excel. So right here, our share price is $262. And we bought 100 shares, so that's $26,200. This is compounded monthly, so that's 12 times a year. And we are doing this for 8 months. We're receiving 3%. So if we follow this formula right here, which is our principal times 1 plus our rate, which is 3%, divided by the amount of times it's compounded, which is 12, and then we raise that to the time that we are holding this, which is 8 months, and then we subtract that by the principal, that's going to give us our interest, the interest that we receive. So here, we can see that we're receiving 26,728.61 at the end of the period. So 8 months later, in our bank account, this is going to be our balance. Now, we have to compare this balance amount 8 months in the future to what we invested. So here is our return on investment. It is $528.61. So what is our return on investment rate? It's essentially this divided by our investment. So that's about 2%. So let's go ahead and double check this number, 26,728.61, with this right here, 26,728.61. There you go. I mean, I essentially just mimic this APY interest calculator in Excel. So what is our options paying us? So we could go ahead and calculate that as well. So let's see, we were looking at the 200 strike for June 30th of 2023. So let's go ahead, let's put that information down. So here I have the date. Now the strike was 200. Now what was the premium? Let's go ahead, let's look at that again. Let's see, premium was 72.05 on the bid side. Obviously, if we could get more than that, if somebody is willing to pay us more than 72.05 and we put something in between this bid, that's great. The more the merrier. But at the current time, somebody is willing to buy this off your hands at this minute at 72.05. So we're going to put 72.05 right here. So, if we have to sell this, if it's above $200 on June 30th of 2023, we have to sell it at $272.05. Our profit is $1,005 like we calculated before, but wait, there is one more component to this. We are receiving dividends in between. So QQQ, they give you dividends every quarter. So they pay that out in the future, but you have to hold it by this date. So if I hold QQQ by June 30th, I'm essentially receiving these two dividends right here. So I have to add to this profit amount these two dividends right there. So let's go ahead and let's do that. There we go. We're going to add that dividend. And we're going to add that dividend. Now keep in mind, these dividend amounts changed quite a bit because, this is an ETF, so it's not just a set amount all the time. It varies slightly. So you do have to keep that in mind, but it should roughly be about these amounts right here per share. So this is essentially what we're going to receive at the end of this contract, assuming that QQQ is going to be over $200 by this date. So, that's $1,101.11. Not bad. What is the return on investment? It's 4.2%. Now, let's just pretend that we want to invest a little bit longer. Let's say we want to go 11 months. So let's pick a strike, an options date with the same strike 3 months into the future. So we'll be looking at September of 2023, and we'd be picking right around the last date. So that's the 29th of September 2023. We want to look at the 200 strike. So this is showing 76.07. So right here, we're going to put 76.07. Strike remained the same. The only thing that changed is the date. So that is September 29, 2023. So that changes our time frame to 11 months. So what would our interest in the bank pay us? I mean, it will give us $729.57. The return on investment on that would be 2.785%. Now, what is this option going to give us? It's going to give us $1,503.11. Our return on investment is 5.74%. Now let me show you something. Let me show you what happens when we start increasing our strike. So let's say we want to choose a 210 strike instead. So we're going to choose a 210. It's going to pay us $68.15. Hey, now our ROI is 6.53%. Let's look at the 220 strike. So 220 strike, 60.65. Hey, now our ROI is 7.49%. I mean, that's much better than what we were getting before. And look at the bank, the bank's just giving us 2.78. So here, this is a pretty nice deal. But what happens when we're raising our strike? I'm going to show you that. Now, there's always that chance that by September 29th, 2023, the stock price could be below $220. So what does that mean? That means you're holding on to your 100 shares, but you pocketed all of this premium. So your share basis is going to go down, and I'm going to show you what your share basis is going to be. So we're going to take our share basis, we're going to subtract it by the premium. So that's $201.35. That's basically what we would own these shares at if, the price is below 220 by September 29th. So yeah, I mean, not too bad. But there is that dividend aspect to it. So we're not going to mess with dividends going into our share basis. We could if we wanted to, but I'm choosing not to. I'm choosing dividends as being something entirely separate. Now let's say I'm not really comfortable with 201.35. Let's say I think that the world is going to the end and QQQ is just going to crash to basically hell. It's going to crash to hell. Now, now I just want to say, hey, you know what? What happens if I get a strike that is less than this? So let's look for a strike that's less than that. So let's choose this 205 strike. So 205, 72, 13. All right. So that would mean that our share price, our basis, would be 189.87 if it's below 205. But if it's above 205 by this date, then hey, my return is only 6.14%. Now I'm thinking, hey, you know what? If the world is going to hell, I want more than 6%. I want something closer to 7. So now, let's try to compromise. Let's try to find something in between. So now let's pick, how about 215? Let's do this 215 strike. So 215, 64, 49. All right, so now we're getting 7.04%. Hey, you know what? If the world's going to hell, at least I get 7.04%. And that's if, the share price is above 215 by September 30th. Maybe I think the world is going to hell after September 29th. So I'd be fine with just selling out, getting my 7.04% return on investment. And you know what? Let's say it's below $215 by September 29th. Well, now I have shares at 197.51 basis. Let's go ahead and let's take a look at the chart. So that's like 197, that's all the way down here. That's not too bad. I mean, There is this little shelf of support right there at around 191. There is a shelf of support right around 175. These are probably the two stronger shelves of support because as you guys can see, this was just going straight up, straight up, straight up, straight up. Now it's going straight down, up, straight down. So yeah, I mean, there's not a whole lot of support within all of these areas. So does it make sense for me to want a share basis right around 197? Well, yeah, it's not too bad. I mean, there's a support right around 190, 191-ish. But you know what? Let's just say that, hey, you know what? Now I'm starting to get a little bit worried. Maybe I want to be less greedy. Maybe I don't want 7% anymore. Maybe I want to hedge myself a little bit better. So, let's just look at the options chain one more time. Let's pick a strike that gives us just a little bit more protection. How about we go right back down to that 205? So let's do that 205 again. 205, 72.13. All right, well now our basis is 189.87. Our return on investment is 6.14. Let's take a look at the chart. I mean, if I own it at 189, then yeah, that's right around the support area. So that's not a bad place to want to own it. So you guys can see all the different thoughts that have to go into this. So this really depends on your risk tolerance or just how greedy you are. If you're really greedy, you could just be like, hey, I'm going to sell it even higher. Let's just say I'm going to not do in the money. I'm going to do out of the money. Let's say I'm going to choose, a strike of $280. So 280, 2509. Well, what happens if it's below 280 by September 29th? Well, that's all the protection I get. I mean, my basis would be $236.91. But hey, what's my return? Wow, $4,309. That's 16.81% return on investment. That looks amazing. Now, this is where a lot of people, they get starry-eyed and they look at this and they're like, oh, wow, that's amazing. But what about your downside protection? I mean, let's just say that by September 29th, 2023, let's pretend that QQQ is down to $200. Well, what just happened? You're down several $1,000s. Now you're down about $3,700. So, you didn't hedge yourself to the downside. So that is why I'm talking about selling in the money calls, because not only do you get profit, you also get significant downside protection. So that is the mentality that goes behind somebody selling a deep in the money call. Now, I hope you guys enjoyed this video. None of this is financial advice, and have a great one.